You are getting played. And it's always the same crew, it's big money. Have you ever experienced that? A project sounds amazing, but the moment you buy in, the token price drops. But didn't they told you that they were all about the long-term vision? So, who is selling as soon as you show up? It feels like there is a whole group out there teaming up just to trap small investors like you. Or there is also the situation where you see a project with killer tech and hype. You buy in, and then bam, the price tanks soon after. Doesn't make sense. The technology is really game-changing, so what's happening? I'm telling you. Behind this, there is a key player you might not have paid much attention to. VCs. Venture capitalists. To a lot of people, VC sound like some distant, fancy term. You might think it's something only project teams need to worry about, not you. After all, they are investors. Their discussions and actions take place with the project team. But here is the truth. It's the exact opposite. Every move a VC makes directly impacts whether the token you bought is going to soar or crash to zero. And that we have to worry about. It's our money, so it impacts us directly. As investors, VCs usually scoop up tons of tokens early on at dirt cheap price. Their goal is to then sell them off when the time is right. It makes sense, right? They are investors, they are in it for the money, they are here for one thing, the money. But maybe they are selling too fast. And guess who they are selling to? A lot of times, it's regular folks like you and me. So why do most people never dig into how VC really work? Because most haven't sat at the table and seen how VCs actually operate. We don't know, but I'm different. I've been in the crypto game for 8-9 years, watching projects rise and fall. I've dealt with plenty of VCs and learned they are not almighty gods. Once you get their playbook, you can safely step away every time. It's risky. That's what you have to do. Manage your risk in a more efficient manner. Today, I'm not gonna bore you with complicated jargon. I'll break down, based on what I've seen, how VCs mess with your investments and how you can dodge their traps. Hi there, it's Cédric. If you like this kind of video, don't forget to hit that subscribe button and join my Telegram. The link is in the description. Let's break 2K subscribers. Alright, let's start with the worst kind. There is 3 kinds of VCs, and the worst kind is the fake long-termers. They are always preaching long-term commitment and, value investing, sounding like true believers in decentralization and in the future. But the blockchain data doesn't lie. Often, right after a project launches, they are the first ones dumping huge amount of tokens. Their massive sell-offs crush market liquidity, ramp up selling pressure, and tank the price, leaving latecomers like retail investors stuck with sky-high costs or deep losses. They only care about their ROI, return on investment. They don't care about the chaos they leave behind. So don't brush this off. Check out what we have on screen here. In August 2025, Jason Zhao, co-founder of the 2 billion valued blockchain project Story Protocol, he announced his exit. The community called it a soft rug pull. This project had raised over 130 million from top VCs like A16Z. Yet, on-chain data showed this project hyped as carrying 61 trillion in IP assets. It was in fact pulling in just $45 a day. So it's clear here, it's the perfect example. They talk a big game, but they are the first to bolt. And the founder here, one of the project's biggest VCs, he was supposed to be a long-termer, but he bailed when the numbers looked grim, leaving investors and retail in the dust. So whether you are a regular person or a retail investor, you've got to check on-chain data, track the public VC wallet address. Many projects disclose that after funding rounds. Check the tokenomics too to see the number of tokens allocated to investors and VCs, and monitor. See if they are holding long-term as they said they would, or if they are dumping tokens systematically just right after the project launches or right after the unlocks. For that, you have tools like Etherscan, BSC Scan, Yoon Analytics that can help too, and you can set up alerts. You have to react if what they are doing doesn't match what they said. And you also can be proactive. Dig into the VC's track record. Do they stick with projects or just unlock and run? What did they do in the past? We need to know this stuff, and the data is available. This is part of doing your own research, so do it. Next. The second kind of VCs, it's resource bundling VCs. These guys, they just don't throw in money. They push a bunch of their friends on the project. They promise full support, marketing, tech audits, community management, you name it. For newbies especially, this sounds like a dream. But here's the catch. These partners service, where the VC also comes with a team. It often comes with crazy high costs and spotty quality, sometimes from the VC's own shady side companies. The project's funds, meant for building products and ecosystem, they get eaten up by these overpriced, low-value services. So back on my screen here, let's have a look at this case I pulled up for you. In a nutshell, what happened here? OneCoin claimed to be a game-changing cryptocurrency, but it was just a centralized database. Its founder, Dr. Ruja Ignatova, the founder showed up at big industry events, posing with experts and hiring armies of promoters to push it globally, creating the illusion of broad support from the, cryptosphere. Those experts and partners, basically all VCs in disguise, lending their logo and a little hype, but zero long-term care. The billions raised went to flashy marketing and huge commissions, not tech development. This resource bundling model burned through the funds, leaving the project unable to deliver on promises. So the ending, predictably dramatic. The founder vanished and investors and retail lost everything. This shows that VC resources and backing can just be a shiny wrapper for an empty project. So before jumping in, track where the project's money is going. If tons of cash are spent on vague marketing campaigns or consulting fees without clear results, stay sharp. A VC heavy on resource bundling often means the project either lacks real control or simply growth potential. Then we've got trend chasing VCs. These ones usually come from traditional industries and don't get blockchain at all. They don't understand. Why would they jump in? Simple. They chase whatever is hot. Here is the case. Here in 2020, Block VC's Troy project was exposed for scamming big names like Mars Finance and Note Capital. Mars Finance founder placed its Troy in the group chat, calling its fundraising borderline fraud. The project was suspiciously, cozy with Block VC, even rumored to be run by the same crew. These VCs chase trends and don't spare anyone, not even industry bigwigs. If they are scamming big names at fundraisers, do you really think they will look out for you, for regular investors like us? No. Once the hype fades, they are gone faster than anyone, leaving a mess behind. I've got a personal story about that too. A few years back, when the metaverse, was all the rage, I met a sleek VC that was just back from the Consensus conference. He talked my ear off for 10 minutes, but I realized his idea of decentralization, it was just spreading servers around. He was clueless. You can see the issue here. These VCs, they can't offer real industry guidance or judge a project's long-term value. They are just in for the money. You might jump in a project because a famous VC backs it, but when the hype dies, they will pull out the fastest. The project stalls and you are stuck. Their lack of expertise often means they will pick shaky projects to begin with, and they will just play with the numbers. So dig into a VC's background. Check their past on LinkedIn or Crunchbase or Google, anything, If they are new to blockchain from some unrelated field, be cautious. But no matter how shiny their rep, always go back to the project itself. Is the white paper clear? Does the tech team have real experience? Is the product actually progressing? These are the things to focus on. Alright, we've covered the weird ways VCs operate, at least 3 ways. All in all, they are oftentimes here to make a lot of money as quickly as possible because it's crypto and it's the far west. Good people with long-term quality vision are rare. So yes, now you understand that, but how do you actually avoid their traps? First, use the right tools. Check CoinMarketCap or CoinGecko for token basics and unlock schedules. For deeper dives, platforms like Dune Analytics have user-made dashboards to track VC wallet movements. Then, secondly, always stay skeptical. I'd even stay paranoid. If a project seems too perfect, if it's too good to be true, it promises unrealistic returns, it's probably trouble. VCs backing a project doesn't mean it's safe. The project team will sell it to you like that, of course, but it's the project product and market demand, the product market fit that really matters. And then finally, if you are new to this, connect with trusted folks in the space. Build experience and confidence to navigate the industry. If you are new, or if you are scammed often, find some good experienced people and team up with them. 2 heads are better than 1. You can also add me on Telegram and ask me if you want. My Telegram link is in the description. Alright, after all this, here is my final take. The blockchain world is still packed with opportunities, yes, but it comes with complex challenges. For regular folks or retail investors, understanding VCs isn't about getting cynical. It's about assessing risks and protecting yourself. What about you? Got any wild VC story from the crypto world? Drop them in the comments and let's break down their tricks together. That's it for today's video. If you liked it, please give it a thumbs up, comment and share. And if you found this helpful, yes, hit subscribe. As I was saying, let's get to the 2000 subscribers together. Merci et au revoir.